subject matter. And then I started thinking about the process I go through for all this stuff, because I'm reading constantly, reading the news, reading the magazines. It's all I do basically all day long. The tiny amount of time I spend actually writing something is after I've been reading for a long time. And even these articles I post in the chat are just articles out of 100 and something I've read. These are the ones that I thought were more significant than the others. Yeah, well, I like this one. This is a good article. Turns out Harvard students aren't that smart after all. Why? Because most of them are put there not merit-based. Not most. I'd say it turns out 40-something% are not merit-based placements. They are, alumni placements. They are scholarship placements, for sports or whatever. They're, it really drags them down. That's why it's misleading, because if you want to get into Harvard on merit, it's really hard. But if you want to get into Harvard on wealth, it's really easy. So I thought that was an amusing article when you realize that. And it's really sad, because why do they charge anybody to go to Harvard when they've got this endowment of like $80 billion? It makes no sense. There's absolutely the endowment makes so much money that there's no reason that they would have to charge anybody anything to go to college there. Here's the point I make all the time. Central banks pumped $9 trillion into the economy during the pandemic. And that's official, like the way the Fed is doing $120 billion a month of their QE. That's the official number. It doesn't count lowering rates and taking the losses from lowering rates and so on and so forth, or even increasing the balance sheet, which doesn't count. This is how much money they're directly placing into the economy, not just when they take things onto their balance sheet from the banks and so on and so forth to increase liquidity. Anyway, so the stuff I put up here is the stuff I found interesting enough to share, or I thought might have some market relevance. Now, a couple of times today we stopped and we talked about something that was in the news. That's why I had the news on my mind. Here's Target. It's not that bad. They're down 5%, but they're down 5% from these super high numbers. That's not terrible. You have earnings and you sustain the uptrend, you're in good shape. And they should be, because there's nothing really wrong with their numbers. Oh, here you go. So why do we read the news? We read the news to find stuff out. So Cedar Fair rallies, Deutsche Bank 40% upside, best in class, blah, 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 blah. Okay, fine. Now, I also read already, where did I read it? IGT, Lowe's. Anyway, maybe I didn't pick it out because I didn't find it was interesting. But there, I read an article on SeaWorld, and SeaWorld also getting an upgrade because of increased attendance trends. Blah 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 blah. So, this did prompt me to look more closely, because I had already read that SeaWorld was doing well. We know Disney is packed, and I thought of Six Flags, and I looked up Six Flags, and Six Flags is doing better, but value-wise, Deutsche Bank is right. This is Fun is a really good value compared to the other parks, and I made some notes below. So in other words, you don't know what's going to be useful until it sort of compounds in your head. So in other words, we follow Disney, so I read about Disney all the time. Then I read about SeaWorld. SeaWorld is growing, is really turning around. By the way, discovering COVID, SeaWorld is the best thing you can possibly do in Florida. It's like just swim with the tropical fish. They have an artificial reef. This is what's great about it. They have an artificial reef, and it's basically like being on a little tropical island, except it's fake, because everything's fake and the fish are fake. I mean, sorry, the fish are real, but it's fake how close you get to them, because that would never happen in a real reef. It's designed for you to go snorkeling and be like really close to all the fish, because they don't have murky areas to disappear into, and they don't have, so they just get used to people and hang out with the people. Especially stingrays will like just brush right past your arm and stuff like that. They don't. It's just really kind of cool. So it's like having a really good snorkeling day on a tropical island. Discovery Cove of SeaWorld. That's what it is. It was expensive too. I forget how much, but it was a lot of money. But It was really great. Yeah, so it was cheaper than going to the Bahamas and trying to replicate the same experience, which is what we've done before. But I've been on many cruises, snorkeled in many places. That was the best snorkeling ever, and it was really fun. The whole place was great. So there's my commercial for SeaWorld. But it's not even SeaWorld though. You're not in SeaWorld. There's a different place called Discovery Cove. And you have to totally book it and reserve it. It's not like you can walk in there. So anyway, looking at the numbers for fun, I said, look, these are really good because they're only at $2.6 billion at the moment. They're making $200 million a year. So you're basically at 10 times earnings and 13 times earnings to be exact. And, you know, whoever, Deutsche Bank or Morgan Stanley or whoever, Deutsche Bank is saying $66. And I'm like, I don't, shit, sorry. Good God, people. All right. So I don't care if they go up or not, but I'm saying in the dividend portfolio, because they used to pay a dividend and now they don't. So if they start paying a dividend again, that'll give great support to the stock, and also maybe we want to own it. But I'm saying maybe we want to own it, but we definitely want to own it if it gets cheaper. So since we can sell the 2023 $40 puts for $4, we're going to put $4,000 in our pocket for not owning the stock. And our worst case is if it goes lower, we're going to get assigned at 40 minus 4, which is 36. So our worst case scenario is we get assigned way down here, 1,000 shares, and that would be our initial position. And then, of course, we would sell calls and sell puts and lower the basis from there. So I'm really into owning them at that level. If that happens, it's a very good price, and we're not making a huge commitment. And what are we doing? We're committing to buy $40,000 worth of stock. We're collecting 10% interest or dividend for the year. So that's like getting a 10% dividend for not owning the stock. And your margin requirement, like I said, if it's a portfolio, if it's an IRA, your margin requirement is going to be full and you'll have a 10% dividend. But that's a 10% dividend. It's very nice. And it's a 10% dividend against owning the stock at a much lower price than it is today. If you're in a margin account, your margin requirement should be pretty damn low on this. It's probably going to be something like probably not even $8,000. And so then you're getting a huge return on margin on this stock. And again, it's not one I would worry about because it's so low. You know, your net entry is so low, you're giving yourself a good dividend. That's something I did want to talk about today. So we'll get back to that topic. Don't let me get too far off it. Then what happened? Then we were talking about PEs this morning. This morning we were looking at the NASDAQ PEs, which are really out of control. Where'd my chart for that go? Oh, here. Oh, it's too small. I'm sorry. So the PE from the NASDAQ in 2018, this is not ancient history, was 25. Then it was 20. Then it was 20 in the end of 2018. Then in 2019, the NASDAQ went higher and the PE got higher, but now it's insane. Now it's gone to 37. And I'm sorry, that was on 630. It's now 40. The PE of the NASDAQ is now 40. It's double what it was in December of 2018. And again, it's not that the market's double, so the PE is double. You're paying twice as much money per dollar of earnings for the stocks you buy. You're getting 50% less value for stocks. This is why I hate ETFs. I don't want to be in index funds. I don't want to play the indexes. I want to pick individual stocks that are a better value than their peer group, like fund, like we were just talking about. And it's no different for the S&P. La, 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 la. This is the S&P, and the S&P is, and again, I'm not sure exactly how recent this is, but the S&P is just under 40. And basically in the same place. And what I was saying is you have to realize that the PE of the S&P hit 120, but that was after we crashed, because what happened? It turned out all the bank earnings in 2008 were fake. They were cooking the books and making assumptions that were wildly inaccurate and so on and so forth. And a lot of banks said, like Goldman Sachs said, oh no, we didn't make 10 billion last year, we lost 6 billion. So of course the earnings went from plus 10 to minus 6. That's going to drastically affect the PE of the stock unless the stock goes to some incredibly low number, which it did, because it was, these guys had lost incredible amounts of money. And it also affected the building industry and the land industry, the paper industry, all sorts of things, all the building materials industries. There's so many things tied to housing, furniture. There's so much stuff tied to housing that it just caused a feedback loop that made that all the earnings getting reversed out, not negative, caused this spike in the PE. But eventually, we know what happened. By 2009, the price of these stocks collapsed to meet the earnings of the stocks. And why is that? Because that's an absolute. Because you've got money and you're going to put it into something, and those somethings pay a rate of return. The rate of return at 40 times earnings for stocks is 2.5% per year. It takes 40 years to make your money back on the stock. It takes 40 years for that company to make enough money to pay you back for the share you buy. That's what a PE of 40 is. It's you pay 40 times the earnings. So you have to realize that it's always a choice. And then you look at stocks which are not particularly safe, and then you compare that to bonds, which are theoretically safe, though I would argue they're just as bad, really. And then you might put your money into housing, you might put your money into Bitcoin or whatever. And then it's just a question of who's paying you on a risk-reward basis, who's paying you the best returns. Now, at the moment, like I said, bonds are just as risky as stocks. They really are, especially when rates are rising, because if you're in a low-interest bond and the rates rise, your bond becomes worth less money. And especially in an inflationary environment, the inflation eats into your bond value. So tying your money up in a bond is not risk-free, and it's less appealing than stocks right now. Obviously, housing, if the housing market is going up and making money, which it has been for the last few years, then housing becomes a good investment. But people got so burned from here to here. People got so burned in housing in the last cycle that it's kind of hard to get them back to the table. So we don't have a very big housing cycle at the moment going on. And then there's commodities, and then there's Bitcoin. But when you look at Bitcoin, or all cryptocurrency together is like, $5 trillion, $6 trillion. That's nothing. It's a drop in the market. You're talking about almost a $200 trillion U.S. index market with the Nasdaq, the Russell, the NYSE. Talking about a couple of $100 trillion worth of stocks in the U.S. market. Probably globally, you're around $500 trillion worth of stocks. That cryptocurrency is a 1% of that. So it's not really an investment class. Houses, on the other hand, yeah, let's say there's 1 billion houses in the world. I mean, there's 110 million in the U.S. Then we've got, I forgot, we got 5% of the population or something like that. So figure 20 times 110, that'd be 2 billion houses. I don't think there's 2 billion houses because apartments and so on and so forth. But let's say there's 1 billion houses in the world, and a house is worth $200,000 on the low end. So you're talking about 200,000 times 1 billion is 2 trillion times 200 trillion dollars basically in housing. $200 trillion of housing. Not as big as the stock market. The stock market's bigger than the housing market, but still, or unless I'm wrong and there's 2 billion houses. But, roundabout, either way, the stock market's probably bigger than the housing market. But either way, both of them dwarf cryptocurrency. It's not a serious asset class. At this level, not a serious asset class. Cash, money, is 100 billion US dollars. Although the money supply has been increased, there may be $200 billion floating around at this point. So the money supply has increased drastically. There's probably a half of that in euros. So let's say it's $300 billion in euros, and everybody else is probably in the 200 billion range combined, about the same as, well, dollars and euros are 70 to 80, probably 80% of all money. So if there's 300 billion of dollars in euros, there's maybe maybe $600-700 billion of other currencies. I'm sorry, trillion. So, sorry, trillion. So let's say 400 trillion in currency. And again, cryptocurrency completely dwarfed by the total amount of actual currency that's out there. And even gold. The gold is surprisingly gold. You think gold is like this big thing. How much is all the gold in the world? I think it's $7.5 trillion. So all the gold in the world is $7.5 trillion. Way, way less than you would think. There you go. All the gold that has ever been mined is that big. If you ever, I guess if you haven't been to Egypt, that's not a great example. But there's a better one. All the gold in the world is about the size of the base of the Statue of Liberty. I know it seems crazy because you think that there's so much gold, but most gold that you see is plating, and it's very, very thin. And there simply isn't that much of it. It's a surprisingly scarce commodity. Here's some of it. Look at that. Holy cow. Gold's Fed to print 9.5 trillion and buy all the gold in the world. But there you go. That's what it takes. Are they going to do that? No, they're not going to do that. So that's all the gold that's ever been mined. And there's only about the same amount in the ground. And then that's it. Then we have no more gold. Except, oh, look, it's showing you what is this? I don't know what these numbers mean. Oh, tons. They're talking about tons, how many tons everybody has. So yeah, that means tons, not trillions. And a ton of gold sounds like a lot. That's the thing. Gold's very heavy and dense. So a ton of gold is about 1,000. I don't want to say. Let's say it's 1850 times 16 is a pound of gold times 2,000. So 60 million a ton. That's all. So it's not as much as you think. So the U.S. is 8133 tons times 60 million is $487 billion. Not even $1 trillion worth of gold. That's all the gold in the United States. All right, so when you talk about it being an asset class, what kind of asset class is that? It's so tiny. Asset classes are stocks, bonds, and housing. Oil, metal, minerals, blah, 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 are small potatoes by comparison. All these other things are just tchotchkes that people invest in. They're not really the economy. People have very, very distorted views about what things are worth or what things are investable and so on and so forth. Excuse me. So gold's a good hedge on inflation, but it's not really an asset class. If you're a multi-billionaire, it's not big enough for you to really move it around and have it, have it as a large part of your portfolio. You've got to have a stronger asset class. Where were we? I was talking about something very important. It wasn't the P's, the stocks. Oh yeah, it's dividends, right? Thank you. Thank you, brain. Still working. All right. Natural gas longs did not work out. It failed 490, so we're out of that. That was no good. I know we had at least two things that we reacted to in the news. Oh, Boeing, right. Okay, and again, another example. This is why I was talking about the reading stuff. Now, another example. I have read, I put up the article on Boeing, but I didn't bother mentioning There was an air show last week, and it wasn't exciting, but in my brain, I was registering, okay, air show going very well. There was an exceptional clump of orders for Boeing, had a huge order for 737s. Airbus basically had to stop taking orders for single aisle planes. So it was not wide body, single aisle planes. Airbus was done. They were like, we cannot process any more orders at this point. They were completely jammed up. Why? Because people are still leery about 737s, and more people went over to Airbus, but meanwhile, Boeing took tons of orders. Now, so reading this article here, Wells Fargo with multiple catalysts drive stock higher. I don't want to miss the bus. I know Boeing is cheap. I don't know how. I wasn't dying to jump into it. It's still very weak. It's still hovering around just barely over 200. I would have liked to have caught it more like 200. But if Wells Fargo is starting to notice it and putting on a 272 price target, and they say, and they're right, and as they're saying things, I know the risk reward is skewed positive. They're 30% behind the S&P. The 737 MAX is being recertified in China. The Dreamline deliveries are coming back. The higher fuel cost makes it more important for airlines to switch to the lower consuming planes. From this level, there's less downside, and then on the whole, you say, okay. Then you say Boeing. Backlog. So by the end of December, Boeing's backlog adjustment was 5,000 aircraft, of which 4,000, 80% were 737 MAXs, blah, blah, blah. All-time backlog was 5,600, was 5,900 in August. Before they had problems, they had 5,900 backlog. So how much is the backlog? The 737 MAX problems have cost them, in the end, 20% of their backlog. But that's silly. How many planes does Boeing make a year? So, well, in 2020. All right, so in a normal year, 380, and it's compared to 380 and 806 in 219 and 218. So 1,000 planes a year. So if they're cranking them out, they're going to do 1,000 planes in a year. Cranking. Airbus, 566 delivered. All right. So Boeing 806, Airbus 566. Maybe Airbus can do a comparable amount. The bottom line is Boeing has 5 years worth of orders on the books right now. Every time they go to a show, they book another 1,000 orders, puts another year behind. So if you have a company that knows for a fact that for the next 5 years, you've got every single thing you can produce is going to get bought, you are able to make quite a lot of money. You're going to crank out the cash. And Boeing is a very reasonably priced airline in the first place. So we decided to make a play out of that too. So I said, there's one I can get behind at 224, blah, blah, blah. You know, my big concern is they lost 12 billion in the last couple of years, and they're losing $1 billion this year. Next year, 3.2 billion. So it's not a super fast recovery. But when they get back to normal, they're going to make $10 billion a year, and they will get back to normal because the orders are there. It's not like they're going to have to struggle and advertise and have a buy Boeing campaign. They're sold out. They're sold out next year. They're sold out in 2023, 24, 25, till 29, they're sold out. And by 29, they'll be sold out until 35. It's never going to stop, okay? People need planes. It would take a good 5 years for any competitor to start ramping up to become as big as Boeing. No Chinese airline is going to come out of left field and start making planes. No Brazilian airline is going to start making planes. It doesn't work that way. It's a massive, massive undertaking. Look at Tesla. Look at Tesla. They've been on the attack for 10 years at the car industry, and they're up to 500,000 cars. Maybe they'll make 1 million cars next year out of 70, 80 million cars in the world. It's not easy to take on the big boys. Boeing has, first of all, with Boeing, you have to build special warehouses. The warehouses aren't even normal. They're double size, triple size, super high ceilings, special this, special that. It's almost like an Intel clean room in the warehouse, except it's massive. And the same thing goes with Intel, by the way, so where I like Intel. It is not easy to build these facilities to make these chips. You know, it's not like, you know, it's not like anybody can do these things. So anyway, so the bottom line is I think they'll get back to normal. I think this is a good price, but what I do know is I know that if I sell 5 200 puts for $30 and I net in for 170, I definitely want that. I definitely want to be in at 170. So here's 230, so 170 would be down around here. So I know for sure I'm going to love owning Boeing at 170 in the long-term portfolio because again, 170, they still have the orders. Whatever bumps in the road they hit, they're going to get around it. So you put your foot down, you plant your flag, and we get paid $15,000. We 5 times $30, 500 contracts times $30. We're going to get paid $15,000 to promise to buy Boeing for a net of 170. All right, almost certainly that's not going to happen, and we're just going to keep the $15,000. But I like $15,000, so we're going to keep our eye on Boeing with a short put in the long-term portfolio. We're going to watch it, and we're going to have it like that. Okay, great. So, see if we have any questions. No questions. I'm doing fantastic then. All right, now let's talk about what happens when you own these things. And now I'd like to get some audience. Oh, look at that! Wow, poor oil. So that's my S&P. These are the same. Well, they're not the same. At some point, we sold a couple, and then we bought a couple back. We bought a couple back to go longer. So like down here, we were like went to -2, and then we went back to -4 up here, and the current average is 47.02, which is up here. So we're at 47.02. Now I'm not looking to make the short-term money here. What I'm playing I'm playing the shorts on the S&P because I want to have them when and if it collapses, and these are going to be $20,000 instead of $2,000. I hopefully want to catch a nice big fat dip in the S&Ps. It looks more like this. So I keep playing. You know, I'm going in and out on the, you know, as it goes in the channel. When I see a channel and I sell a couple, I buy a couple, sell a couple, buy a couple. It's a pain in the ass, but it's my goal is really not so much to make the money here, but to just keep raising that basis as high as I can, so that because each time you make a good trade, you end up with a little bit higher basis, and then we hopefully will have a good solid four contract short when it takes a big dip. But what was I going to say? Oh yeah, dividends, right. So the point of this is, all right, let's take a quick look. We have a portfolio for this. We have the dividend portfolio. Oh, I'm sorry. Let me say, I wanted you to participate. So here's the dividend portfolio. It's 2 years old now, and it's up 100%, just under 100%. All right. These are pretty much covered calls that we sell on purpose to collect dividends. Notice basically every single one has a stock, a call, a put, a stock, a call, a put, so on and so forth, right? And that's because Yahoo here. Okay. Then that's because of this. Look, if you just own Boeing, there we go. Okay. So here's Boeing. Here's 5 years of Boeing. Okay, ran into rough times. They were getting to 400 a share. Now they're 200 a share, and I'm telling you, I want to get in for 170. This is my get in spot right here. Okay, so I'm willing to buy it here, and you can see why based on this long-term chart. Right, it does not really stay below that level. That's the 2017 price of Boeing. the pre-Trump price. And I like pre-Trump prices because pre-Trump prices are before stimulus, they're before the lower corporate tax rates, so it's a good indication of what a company would be doing if nothing else had happened and they hadn't grown. So even if you take away the stimulus and take away the corporate tax rates, you still have some growth since 2017. So this is a really, really safe level down here, 180 that happens to be. Anyway, so you can own Boeing and it goes up and it goes down. But meanwhile, if you had bought Boeing at 200, let's say you came in around 200, it's only at 225 now. It's up 10% in the last year and a half since the big crash. And there's nothing wrong with that. And now Boeing, if you look at the stock, oh, they still not paying a dividend? That's going to make them a bad example. Oh, you bastards, you didn't get back to your dividends yet. All right. Anyway, still make my point. So you got no dividend and it went up 10% in a couple of years and you sat on it and sat on it and sat on it, right? So meanwhile, now let's look at a 2-year chart. Okay. So Boeing, if you owned it at 200 over here, if you finally put, if you put your foot down something to buy Boeing here, or probably put your foot down here and it went further down and you got upset. But if you own Boeing at 200, you can see that if you sold a short 200 call, you'd be a winner, a winner, a winner, a loser, a winner. If you rolled it, it would turn out to be a winner, a loser, back to being, well, I mean, now you're at 220, but, not too bad, not too bad, not too bad. All right. So if you rolled it or whatever, you wouldn't have had any trouble with this stock. Now, how much would you make? What's the difference? Well, the difference is gigantic. This is the point I want to get across today. If you're not getting, even if you are getting a dividend from the stock, the point is to pay yourself a dividend. So if I own Boeing at 225, if I bought it today at 225 and I just wait, what's it going to do? Go to 250, go to 300. If it goes to 300, I make $75. So let's say in 2 years it goes to 300. That's $75 up. That's what, 30% up from where it is now. That's a nice move. So I'm going to make $75 if I wait over 2 years if it goes to 30. But instead, if I take my stock at 225 and I sell, and I generally like to sell quarters, so I'm going to sell like 90 days out, which is going to be February here. All right. And if I sell the February, right where we are now, the February 225 calls, $17. All right. So if I sell $17 worth of calls, 17 times 8, I have 8 quarters to sell $17 calls. It's $136. And what's the worst thing that can happen to me? The worst thing that can happen to me is, well, I mean, look, okay, a Boeing goes down. I'm sorry, the worst thing that can happen in connection with selling calls. There's nothing wrong if Boeing goes down. I'm $17 better off than I was. At least I got $17 for the calls to buffer my drop. Almost a 10% buffer to the drop. So I sell the 225 calls for 17. If Boeing is flat, it's still at 225 and I make the $17 on the calls. If Boeing is up, the worst thing that can happen to me, that's what I mean by the worst thing. If Boeing is up, the worst thing that happens to me, my gains are capped at $17. I get my 225 back if I sold those calls, plus the 17. And that means in 90 days, I made 17 divided by 225. Freaking 7.5%. There's nothing wrong with making 7.5% in 90 days. I didn't do anything. I didn't take a big risk. I was going to own Boeing anyway. I was just going to own it naked, or I was going to listen to Phil and sell the calls. Now, The only thing that's really bad that's going to happen to you is Boeing goes to 300, and now you got to sell the freaking thing for 225 plus 17, which is what, 232, 242. So in other words, if Boeing takes off and flies to 300, you can't roll it, you can't do anything with it, you're just going to make less money. But that is bullshit thinking. When you sit there and say, I could have made you, and you know this, you know that's like gambler thinking, right? Could have made that, should have bet on a long shot, should have done that. Oh, it was 00, I knew it, I should have bet on 00. That's not how it works. But you for sure are going to make 7.5% on anything flat or up in the quarter. You're going to make 7.5%. That's 30% a year. Remember what I just talked about in today's article, how 27% per year is ridiculously unsustainable, and here I'm guaranteeing it. A 27.5% boost in the market is an aberration, but here I can give myself 7.5% in dividends every single quarter, 30% per year. And I still own the stock, and it is flexible. So what's the flexibility? Well, let's say last quarter, I had sold 200 calls of January, right? And now we're at 225. So if I sold the 200 calls for 17, right? We just saw what the quarters are. So if I sold the 200 calls for 17, how much are the January 225s now? No, I'm sorry, the 200 calls. So the 200 calls are now 29. How much am I down? I'm only down $12. I sold them for 17, now they're 29. I'm down $12, right? What do I do with them? I roll them to the let's say March. I roll them to the March. I'm sorry, they were 29, right? I'm going to roll them to the March 225, so they're 18, 19, yeah, about 19. So they're 19. So what am I doing? I'm taking a $10 hit on the roll. I'm going from a $29 call to a $19 call. But I originally sold those calls for 17. So I'm only rolling my $12 loss into a $19 call, so I'm still netting $7 on the roll. I haven't lost anything. My stock gained 10%. I now have a 10% higher strike where I'm being called away. So even though you feel bad about it because you didn't make money on the short calls, you're not always going to make money on the short calls, but what you are always going to do is be protected to the downside. You're always going to be guaranteed at least a certain gain, in this case 7.5% per quarter. It changes obviously quarter to quarter, but you're going to gain about 7.5% per quarter. Yes, you do have the ability, and we do this in the butterfly portfolio all the time. We vary our bets depending on where we feel we are in the channel. So in other words, when we're close to 200 with Boeing, we would tend to sell less calls or sell calls at higher strikes or do a partial cover or something like that. But when we're higher, when we're close to 250, we tend to get more aggressive with our sales because we feel that that's the channel. And it is a channel. This is a channel until it isn't. And we'll know when it isn't, it'll break out of it. And then we'll say, oh, that's not the channel anymore. If it breaks up to the upside, we're going to get called away maybe or whatever, or we can change the stock and add to it or whatever. But the point is, I'm talking about the lowest impact way you can do it. I'm talking about if you've got a portfolio sitting there and you've got your Boeing stock, your IBM stock, your AT&T stock, things like that. It's, first of all, it should be stocks that aren't going to get bought out. If the stock gets bought out, you can get screwed because that's when you don't get a chance to roll or do anything. The stock gets bought out and blah, blah. So you don't want a stock that's going to get bought out. You don't want a stock that's going to go bankrupt. But for a normal, good-sized, blue-chip stock that's almost certainly going to be there next year and the year after and the year after that, it's crazy not to sell short calls. Crazy. 30% a year and you're not going to make the effort? Do you make 30% a year? And the answer is no, you don't make 30% a year, because 30% a year means you'd have $130 million by now. We're all more than 40 years old. We're probably all 50 years old, right? And I just showed you that in 30 years, $10,000 becomes $130 million if you make 30% a year. 27% in this case. So 27% a year, $130 million. Is that too much bother for you? And you know why it is? Because of this. See that zero? Still pretty much zero. Still pretty much zero. Still kind of zero. It's not very exciting for the whole first 1/3 of the process. For the first 10 years, this process sucks. You're just grinding it out. But then it starts to accelerate and feed on itself, and it becomes faster and faster and faster. It's the same 27% in this example every single year, the same 27%, but it's 20% of a bigger number and a bigger number and a bigger number every year, until you start seeing, holy crap, 27% of 100 million is $27 million. That's a lot of money, especially when you started with $10,000. So, get off your ass and start making the money. And if you look at, and here, let's take a look back. We're going to go back to Boeing. Chart. No, not that. That one. So here's Boeing forever chart. Maybe it'll work. Ooh, doesn't like me. Oh. Come on. There we go. So here's the Boeing forever and ever chart. Started in 1962. Well, the chart did anyway. The company started. So 1962, we're at $1, and now we're at $38. I'm sorry, we're not at $38. Now we're at $200. So Boeing is up 200 times. And it was 400 at one point. So, but Boeing's up 200 times. It went up as much as 400 times since 1962. And how many years is that? That's 50, 60 years. Wow. That's crazy. It just doesn't seem like that was 60 years ago. That's like me watching Charlie Chaplin. Oh my God. Really? Is that what I seem like to my kids? That's like, oh wow, that's horrifying. Yeah, that's like us when we were babies, when we were young kids watching Charlie Chaplin movies, and that was like old-timey days, right? It was very obviously like, oh my God, that's horrifying. That's what our kids feel like when they look at our shows when they look at stuff from the 60s. They're like, really? Like cavemen. So anyway, so in all this time, yeah, it goes up, and sometimes you would get called away, and if you want to, just buy it the frick back and start again. Getting called away doesn't mean you shoot yourself. All you do is miss some of the gain, but the constant gains, you miss some of the gains going up when it goes up sharply, but then you make gains where other people are losing money on the way down. And then you miss some of the gains coming back, and you make gains when everybody else is losing money. And these are very tight looking, because when you actually go to a 2-year chart, it no longer looks like, you realize you're not actually getting burned. Again, here you're at 330. So you sell like the 330, 340 calls. Goes up, it goes down, it goes up, it goes down, it goes up, it goes down, it goes. You're doing fine selling calls. Here you might get called away, but then it comes back down. You buy in again and sell more calls. It works most of the time. Doesn't work some of the time. Works most of the time. But that working most of the time and guaranteeing yourself a 30% boost on the stock price every year, you're going to do great. And then especially If plus the stock is paying a dividend on top of that, now you're making just insane amounts of money. You realize at 33%, every 3 years, you've gotten all your money back on the stock. And that's true too, because that model that we were looking at, it doesn't take into account dividends, doesn't take into account redeploying your capital. But this is, I think, really something we got to get across to people, especially the parents. My mother, her friends, I talk to them all the time, and they just have the money's just sitting there. They're living off these stupid little checks they get from like Raymond James and people like that. And they have these accounts that are invested in the S&P, blah, 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 but they're terribly invested. They have $200,000 in an account, and every quarter they get a check for like $4,000 or something like that. It's $8,000 a year. It's 4%. Better than a savings account, but it sucks. And again, I'm not talking about risking your money. I'm talking about selling. They can't take it away from you. When you sell, when I sell the March $225 call for $19, okay, I'm buying Boeing 225, all right, minus 19 because I'm selling the calls right away. I'm spending 206. If I get called away at 25, it's 19 divided by 206. It's really 9.2% back on my cash. Okay. Now, can they take away my stock? I mean, if I get called away, they can take away the stock, but they're going to take away the stock with a 9.2% profit. They can't stop me from making 9.2%. If the stock goes down, yeah, I'm going to lose money, but the call expires worthless and I keep that money. So my net at 225 minus 19, my net is 206. And so if it goes down, I don't lose money. I'm still way ahead of people who just had Boeing and sat on it, right? There's no penalty to this. You're not risking, you're not risking grandma's retirement account with this strategy. There's no harm to it. All you're doing is putting it to work. Yes, the market could drop. That's a whole different story. Obviously, you have to always be worried about that. But if the market drops, the market drops. But overall, year after year, quarter after quarter, you are so much better doing this. It's criminal negligence to just have the stock sitting in the portfolio. So instead of paying grandma, instead of grandma getting a $2,000 check on her $200,000 account, she gets a $20,000 check or a $17,000 check or whatever they have, or a $15,000 check. You think that will matter to her? You think grandma won't you think grandma would mind getting $60,000? She's not losing the stock. And we're not even talking about the dividends also, not losing the stock. And I'm not talking about selling puts. That's a whole nother dimension. And I'm not talking about taking a risk, and I'm not talking about timing it. I'm saying, for God's sake, why would you leave these stocks sitting around gathering dust when they could be going to work for you and making money? That's the whole point of stocks. And especially with inflation and all that, you guys got to get on the stick, and you've got to look at these people. I'm sorry, I just run into it. Every single person I meet in my mother's groups are like this. They're all sitting there with these ridiculous little stupid managed accounts, and the ones that have an actively managed account are even worse because those guys are losing money. I'm like, how are you losing money? It doesn't make any sense. Market's up 30%. So I really want to make this point, and I'm going to probably start doing something about this, because I can't believe how many people there are who do nothing but just sit there and stare at the stocks and collect a little dividend, or they got their money in an index fund. Even if you're in the SPY, even if you are in the index fund. So SPY is 468. And where the hell's the stick? La, da, 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 there it is. All right, so it's at 468. The March, and again, I'm not trying to be fancy, the March 468 calls are 17. All right, so 17, 468, whoops. But it's not really 468, it's 3.6%. It's really 468 minus 17. That's what your net is. You're buying it for 451. So it's 17 divided by 451. What? 3.7%. Okay. That's still the same amount. So it's 3.7%. So that's per quarter. That's in 121 days. That's 4/3. So even with the SPY, you're still doing about 12% per year, additional to whatever the S&P does. It's very simple. If the S&P goes up 20%, you might miss some of it. But if if the S&P goes up 20%, you're still going to make at least 12%. No question of 12%. If it's flat, you're going to make 12%. If it's down, you're going to lose 12% less than people who aren't doing this. There's not really much of a lose situation of this thing. And that's huge. Okay, that again goes back to if your grandma has $200,000 in the S&P 500, and she's getting these dribbly little checks from her whatever mutual fund she's in. Instead, she could be getting 12%. She can be getting back $24,000. And that's an index fund. I wouldn't be in an index fund though, because you can do a lot better with stocks like Boeing and things like that. How about AT&T? If I could find a catalyst for AT&T, $25. And that brings us to another portion of what we're doing is, but let's say AT&T, $25. The February calls, there are no February, it's March. So it's 24.60. The calls are 95 cents. So 122.40, yeah. So 25 cents. So 75. So I'm sorry, 95 cents. So let's say $3 for the year. So $3. Where'd my calculator go? So my fault. I'm sure I closed it. All right. So it's 24.62 minus $3 because I'm going to collect $3 in dividends. 21.62. So now it's 3 divided by 21.6. Wow. Oh, no, I'm sorry, that's for the year. So it's 14% a year for AT&T. Plus, though, AT&T pays a 6% dividend, which I'm sure is going to get cut at this point. This is crazy. Yeah, paying a $2 dividend, 50-cent dividend every quarter. So if I collect the $2 dividend, though, now it starts to get interesting. If I collect that $2 dividend, and I'm buying the stock for, I forgot what it was, $24.65. So if I buy the stock for $21.65 and I'm dividing by 5 divided by 21.65 is what I'm laying out for the stock because I sold the calls. What? That's 23%. So now I'm making 23% on $200,000 worth of AT&T. I'm going to get $46,000 back in dividends and short call sales every 4 years, I'm going to get 100% of my money back on this stock. So we talked about low PEs. You have to take all that stuff into account. How much can I make off of this thing? And boy, do people hate AT&T now. But meanwhile, I would never do that because it's kind of a waste. Because in AT&T, if I think they're going to hold 25, I'm going to sell these guys for almost, they're not going to be quite $5, but whatever they are, like $4.45, $5.10. These guys are $3.40, $3.90. So let's say they're $3.70. They've got a 50 delta. So it should be $4.70 at least. So there you are. So 470, figure 475, 480 range. So let's say 475. So 475, I sell the $25 calls for. That nets me in for $20.25. Now I'm not buying the stock. I'm promising to buy the stock for 20.75. Okay, that's lovely. I haven't done anything yet though. I'm not going to collect any dividends. I could though. Let's see what works out better. So do that. Half of that. Yeah, because we were only going to make $5, so that's probably smarter. So instead of buying 1,000 shares of AT&T, I buy 500 shares of AT&T, and that's going to be. And then I sell these puts and calls. I'm still going to get the dividend. So the dividend's $2. I'm going to sell the put. I'm sorry. I'm going to sell the shorter term puts and calls that add up to $3. So every year I'm going to get $5 back. So in 2 years, by 2024, I'm going to get $15. I'm going to get $5 this year, $5 next year selling puts and calls is $15 plus. I'm sorry, including the short puts. So I'm laying out 21.65 in the first year. I'm collecting $3 back, so I'm only laying out 21.65. My call away is $25, so I'm fine if I get called away. I'm going to make $3, but I'm going to make $2.50, which is or $3. No, I'm sorry, I'm going to make $3.50. So my call away is at $25. I'm going to make $3.50. So if I ever get called away, I'm never going to complain about it. It's quick money, and I'll just get in again. So I'm going to make on call selling $3 the first year, $3 the second year. On dividends, I'm going to make $2 first year, $2 second year. So that's $10, and the short puts are $5. So I've got. Hang on, you know what, I got to do it this way. 24.62, and how much are we going to collect? We're going to collect $15. So I'm down to $9.62 net on AT&T, called away at 25. Now, you're subtracting as you go along, but the bottom line is if I get called away at $25, I'm up $15. It's not really 150% of what you laid out, but you understand what I'm doing? In other words, I'm just trying to figure out how you can explain how much you're getting in. But your initial year is 24.62. Then the first year, I'm sorry, you sold the puts for $5. That's where your net's dropping. And the net was dropping somewhere. So let's take off the 462. So let's say you're in for net 20. You have 500 shares. You promise to buy 500 more, 25 if it comes back down. So you're at net 20. Then you're collecting $5 a year. You're collecting $3 in dividends and $3 in things. So therefore, you're going to collect $10 over 2 years. We already counted the puts. You're going to collect $10 over 2 years, and your net will drop down to 10. So if you get called away at 25, you have a $15 total profit. And when I say your net is $10, you put that money back to work. It went somewhere, right? If it comes in, the $5 comes in, goes somewhere, goes back to work. Or you could say it dropped your net, but either way, money's no longer in the trade. So what could be better than that? Look how conservative this trade is. Now, if you have an IRA account, you would be charged as if you had 1,000 shares of AT&T at $25. You have $25,000 in margin, but you're still going to end up making $15,000 against $25,000. It's 40% over 2 years. 40%. So in 5 years, you're going to get 100% of the stock's price back. But that's charged against margin. If you don't have a portfolio margin, if you don't have a IRA account or a 401k account that charges you full margin, the margin's negligible, and you're putting very little cash to work into this trade. You can really turbocharge your returns with these things. That's what I'm saying. I wouldn't do that because I'm not a grandma with an IRA account living off my life savings. But if you can do this and enhance it to a point where you're making just incredible returns, and your returns are what? Betting AT&T is going to hold $25? I would have had the same conversation with you at 30, though. So I'll tell you, who knows what it's going to actually do. So Clay says, what's my opinion of Western Digital as a new trade? Western Digital is a very nice company. Cloud storage, Internet of Things. Everything needs to have little devices. Everything needs memory. All these autonomous machines and computers and robots and things running around. They all need some sorts of memories and so on and so forth that Western Digital provides. They're very big on cloud supplies and so on and so forth. So good company. I haven't looked at them price-wise lately. But the bottom line is, where are they? So WDC, they have a low PE. Let's see if they're probably worth looking at. I haven't looked at them in a long time, so I couldn't tell you. Wow, is that slow? What are you doing? So, it asked me in chat, and the same goes with Activision. Activision, I wouldn't be so hot about, though, because it's, they're a gaming company, and I don't know what's hot. I honestly, it's hard to say what's really hot these days. I know they just pulled Warcraft out of China. That's why they're cheap, and they might be cheap for a good reason, because who knows what price was backed into Warcraft for China. And I don't know what their game pipeline is. When you're betting on companies like that, you got to keep track of a lot of stuff, and that's probably more research than I'm going to be willing to do. I used to pay attention, but I lost track of games, and once you lose track, you just don't know what's going on. Oh, look, see, they're a falling star according to this thing. So would I pay $51 billion for Activision when they make $2-3 billion a year? It's pretty good, $2-3 billion a year, but how much of that is boosted from everybody staying at home, and will it be sustainable as people are getting back out? The expectations are it will, but we don't know if that's true. And again, I don't know what their pipeline looks like. I don't know what the games look like. So I would not really have an opinion on them as far as that goes. Western Digital, on the other hand, I think I'm fairly clear on them. They've got storage, they sell storage devices. They're used in lots of different things. They've had some gangbuster numbers. Look at these exploding profit numbers. So you know what? I would want to get comfortable where this came from. I don't know where this number came from. That's weird. So sales are the same, right? They were 20. They were 20 here. They went down a bit. And they recovered. Now they're coming back to 20. But profits completely exploded. Why? And if I don't know why, I'm not going to bet. I'm not going to invest in them. I got to understand why they went like that. What did they do? Maybe they sold off a division and made a lot of money. It's very hard to say why something like that would happen. They seem interesting, but too interesting, and it makes me uncomfortable. Is Seagate still a thing? Yep. Now, see, Seagate's not doing that. So I want to understand why Western Digital is crushing it all of a sudden. Seagate's margins didn't fly up. Seagate didn't start suddenly making massive profits off the same sales. So, you know, before you jump into something like that, you got to understand why they're making that kind of money. And I don't know. Steve says, I trade an IRA, no margin. Is it better to do a strangle on a stock or do 2 covered calls since the capital use is essentially the both for both approaches? I think it depends on the stock and how sure you are about it, and also whether you're getting good money for the puts or not. So, you know, it just depends on the stock. If it's a very expensive stock, it's hard. A cheap stock like AT&T, I don't consider it much of a burden to promise to buy more stock for $25. I'm certainly getting my money's worth because I'm getting paid $5 to come in at net 20. So I'm getting 25% over 2 years for selling that put. It's good money. But the question is always, what else would you be doing with it? So is it worth selling that put, or are you better off buying the stock for $24 and selling the $25 call for $3, let's say? And I take it you can't sell a short-term naked call if you're already covered here. So, you know, you're kind of limited in what you can actually do. But, you know, either way, you're putting out the full margin on AT&T, and one way you're going to be collecting the margin by selling the put, and one way you're going to be collecting, and one way you're going to be collecting dividends and collecting the short call money by selling calls against it. And you just have to evaluate each one. There's no like single answer that says always do this, always do that. You have to weigh it out, look at the total margin requirement, think about the risk exposure to it. In other words, you know, are you better off diversifying? Because sometimes you are. Like if you go to SunPower, one of my favorite stocks, possibly our stock of the year, actually very high in contention at the moment for our stock of the year for next year, even though they jumped to 31 now, which they were not. I was much happy with them when they were 20 something. So SunPower at $30, you can sell these puts, the 2024 $30 puts. You can sell those for like $8.50, something like that. That's a substantial discount. $8.50 is 25%, something like that of the price. So if I don't have to own the stock and I'm going to be in at net 21.50, let's say. So I'm only at net 21.50 and I can make 8.50. My worst case is owning it for 21.50. Best case, I make 8.50, and then 8.50 is 40%. So I'm selling that put, I'm getting 40% back on my margin requirement. And what am I getting it for? I'm getting it for promising to buy SunPower for $21.50. That's like a no-brainer. If I got cash sitting around, you know, you got cash sitting around. Hey, would you buy SunPower if it was 30% below the current price? Oh, yeah, sure. Okay, well, then there you go. Then promise to do that with your money. You know, it's a question of what else do you have to do with it. It's problematic when you short a stock like IBM. You want to find big stocks that are that have low prices, like Ford, although Ford has gone away too much, but something like Ford, where the 2024 $15 puts, Ford's 20, almost at 20, the $15 puts at 260. So you're going to net in for 1240. 1240 is a significant discount. 1240 is definitely something Ford is worth. So technically, this is free money. And meanwhile, you're netting 1240. You're getting 260 back. So 260 divided by 1240 is 21%. What? Doesn't sound right. 260 divided by 1240. Here it is. Okay, thought it was bigger. So you're getting 21% over 2 years for that. Now, it's better than cash. It's better than putting it in the bank. But the problem is, it's a mindset. You have to really want it. You really, really have to want it. You can't kind of maybe sort of want it. But, you know, because you're going to take your cash and say, instead of sitting there and putting it in the bank where it's cash, I'm going to promise to buy Ford because it's going to take that cash and use it for margin. And you say, I'm going to promise to buy Ford if it gets significantly cheaper, if it drops 30% or something like that. I will promise to buy Ford. You have to be excited to buy Ford at that price. You have to really want it and have room for it in your portfolio and have room for it in your retirement plan and so on and so forth. To say if Ford gets back down to $12 and whatever the hell I said, $12.40, I'll own it. Now, mostly people are going to say, hell yeah. Now, speaking of reading, okay, another one I think I probably didn't put in the post, or maybe I did. I don't remember if I did or not. There's an article today where somebody, I don't think I put it in because I decided I didn't think the analyst had made a good point. But there's an analyst saying that electric cars are going to hurt the legacy auto industry, especially. Oh, I'm sorry. It wasn't the automakers because they're going to make the electric cars. It's the auto dealers. And I thought he had some point, but not the kind where I would sit there and panic out of auto dealers right now. But I will say that when you think about the concept of self-driving cars, electric cars, so on and so forth, that I'm pretty sure at some point, probably around 10 years from now, you're going to go online, you're going to buy your car on your computer, and your car is going to drive itself to your house. Your electric car will drive itself to your house, and that's how you'll buy a car. You'll buy it online, the car will show up. Why would they do anything else? And not from a dealer. What do you need the dealer for? The manufacturer will put the car together and send it on its way over to your house. Obviously, it's not going to drive all the way from Detroit or wherever. It's going to, you know, they'll put it on a train and they'll get off the train and go to your house. There's no reason for the dealer. It's, you know, Tesla's right. They have showrooms in the mall. You know, that's how Tesla is doing in a lot of states. They have you go to the mall and there's a Tesla showroom and you see their 2 or 3 cars that they have, and they just tell you to go online and buy it. And there's no reason not to do it. Now, people like test driving, so on and so forth. There's going to have to be some sort of hybrid something solutions. That's why I don't think the dealers are going away just yet. But over time, especially when you're not even driving your car anymore, you talk about a test drive. What are you test driving? I guess you'll have to test drive how well the car drives itself. That'd be like test driving your Uber driver. Think about it. Like, you don't test drive your Uber driver. He just drives. It's a car. You get in it, it drives. People, the very personal sort of love affair thing that Americans have with their cars is probably not going to last too much past us and our kids. You know, it's like we're the generation that grew up where cars were like everything back in the 60s, 70s, 50s. You know, cars were cars. I mean, it was like a machine, but they were also kind of new and kind of cool. And our parents had cars, but our grandparents, my grandfather was born in 1903. He had the first car. You know, so cars are a pretty new thing. And so they kind of peaked out 50, 60 years later. They peaked out as a cool, arty, sort of fantastic, look how excellent my car is, and the curvy glass and all the weird stuff that they do with it. All that was great and fancy because it was all new and shiny and exciting. But what's new and shiny and exciting to our kids is an iPhone, not really a car. Kids don't get worked up about cars like we used to. Also, we had nothing else to do. I mean, you know, cars were important because we weren't doing all the stuff that our kids do. We weren't online all the time. We weren't playing games with people in Japan, like having tournaments and things like that. You know, our best friend didn't live in one of my daughter's best friends lives in Europe. We went there a couple of years ago. It was the first time she met her in person after being friends with her for years. First time they physically met. And it's so weird for them to like see each other and be like, wow, it's like a live person. Um, I mean, I talked to this girl hundreds of times on the phone. My daughter used to walk around the house with her on the phone. They'd go places together when they were somewhere interesting. They would like do a live chats. I mean, they were really good friends, but never actually met. They met each other in a gaming room somewhere and just sort of hit it off. Um, our kids have a very different sort of concept of life than we do. And now look at this metaverse thing. That scares the shit out of me. But anyway, so bottom line is kids are not as attached to cars as we are. And when cars start driving themselves, you're going to think of a car more like you think of an Uber. It's like a thing's going to come and pick me up. It's not going to be, you're not going to sit there and agonize over like the color and the interior and the this and the that. It's going to be like, it's a car. Make sure it shows up. Make sure it comes when I call it. So I think that's going to change a lot. Okay. Anyway, so dividends. Bottom line is, because we're running out of time. So the bottom line for dividends, absolutely make sure, not dividends, I'm sorry, so selling short calls. Don't let stocks sit in your portfolio without using them. Don't not sell calls against stocks. It's so dumb not to do that. And you've got to explain this to your parents, because so many of them need more money, and they're especially with the inflation and all that. And you know, like I said, I'm going to work on a portfolio to help do this sort of thing. We have a dividend portfolio. I'm not sure what I'm going to do exactly. It might be something over at Seeking Alpha, because we used to have a thing for that. But you know, it's a boring portfolio. That's the problem. I don't want to set up another boring portfolio, but it's boring. But it's what you need to do. It's certainly what people who are trying to squeeze out money out of a retirement portfolio need to do. And everyone is so scared of options or doing anything with the money, and the brokers are always telling them, don't do this, don't do that, let me handle it. It's like, it's a scam. Anyway, all right. And Clay says, why doesn't anybody like Viacom? I don't know. Viacom is another potential trade of the year candidate, but I need a catalyst. That's the problem. Where's my catalyst? Why should people like Viacom? Viacom just sold off some assets today, and nobody likes that either. Nobody likes anything that, no matter what they do, nobody likes it. So they raised a little cash, sold off some assets to pay off some debt. People freak out about how much debt they have. It's another stupidly cheap stock. It really makes no sense. And as low as it goes, I'm gonna keep buying this. I don't care if it goes to $20. I'll keep buying it. I mean, look at this, 12 bucks. It went from 12 to 100, and then everybody suddenly decided, oh no, that was a huge mistake. I mean, this is 1227, right, to 314. So this is an entire quarter of people every single week buying, and then all of a sudden in 1 week, they obviously earnings were disappointing. In 1 week, it completely collapsed. I mean, absolute lunacy. So I don't know why they are so vilified, why people cannot get behind them. I've talked about it a lot. So I'm not really going to get heavily into it here, but the bottom line is just there's another ridiculous stock that should be bought by everybody. It's another good dividend stock too. I don't know what the dividend is, but it's good. Let's see what they did wrong today. Well, actually, oh yeah, the people who bought in that uptrend are pissed off. They're suing. So Viacom is paying only $1 dividend, 2.73%, not a huge dividend. Look, Activision CEO is embattled by staff and investors. Better pay attention to that. I don't know why that's in the Viacom news, but I love these class action lawsuits. They're great. That's all it is. There's no news. There's no actual news of Viacom. It's all about a shareholder lawsuit. Viacom stock will get a big boost from restructuring. Paramount Plus streaming assets should become clear. Blah, blah. This is just idiotic. I'm sorry. I mean, I don't understand how it's possible that people don't see the value in this stock. And I guess the lawsuit's throwing people off or whatever, but it's just ridiculous. Well, like I said, we talk about it too much, so I don't want to every week should not be the Viacom show. Every week should not be the SunPower show. But for goodness sakes, people, $23 billion, and they're making $2.4 billion. $2.4 billion, very boring, but it's very consistent. They made $2.4 billion in 2020. That's not even 10 times earnings. They don't have a lot of debt. They didn't even lose money. Most companies lost money at some point in here. They're going to recover back to $3 billion, and it's got $22 billion market cap, like 8 times earnings. This is crazy. If you're not going to buy a stock because it makes money and returns capital to you, what are you going to buy it for? What is the point? I don't understand. This is the whole reason you want to buy a stock. Look at the revenues. They went way up and they're up. It wasn't when they merged, of course. They went way up, they're up, they're going up higher now. Net income took a turn down, but it's freaking, we had a virus, it was a pandemic, and then when now it's coming back up. It's just, I don't get it. I really don't. Like I said, look at the PE. The PE range is down around here, 6.8x. I'd like the dividend to be a little stronger, but I think they should probably return a little bit more cash at this point. But there's nothing wrong with this company. It is crazy. It is crazy how unloved they are. And I think once the lawsuit ends, we'll get a nice pop out of this thing. And it doesn't matter, even if they settle. They're not going to settle it though, because they're going to say, "What are you talking about? Nothing really happened." The company didn't say they were going to make more money than they made or anything like that. The speculators came in and did stupid things with it. Anyway, so now here's another one. Could it be the stock of the year next year? It could be, but you got to have a reason. Why now? That's the question. I'm going with Viacom. Why now? We talked about Barrick Gold last week, GOLD. That I have a reason for it because of inflation and the Fed and the money supply and so on and so forth. And it's like looking at stuff and you say, well, people are going to go back to gold. I think gold's going to be a thing. I think gold's going to break 2,000 next year. That's a good reason to have an investment in Barrick Gold. I have a catalyst there. Don't really have a catalyst for Viacom other than it's stupidly cheap. That's a catalyst, but it doesn't really make it the stock of the year. The stock of the year needs to be stupidly cheap and have some kind of catalyst that's going to make it take off next year. So I am struggling, and we'll go over more of those. Well, next week we're picking stock of the year next week, so I better go over them next week. So I'm going to finish off the portfolios, and I'm turning my attention to my stock of the year pick. All right, and we're going to wrap this thing up. I think that's enough talking for me, unless anybody else has any major questions. SK says the Viacom collapse was due to Archegos. Really? So, they sold off because they had a big stake in Viacom? Maybe. Either way, though, at some point that's got to end. And thoughts on natural gas, Neil says. And we talked about natural gas earlier. The thing is, now again, I read in Europe that they're delaying the pipeline from Russia through Germany because technical reasons, not a permanent thing, but they delayed the pipeline. So it seems to me that natural gas should bounce up here because you're not getting that Russian natural gas, and people should come back in and speculate. That did not happen, though. I thought we would have a little bounce back over 490. Didn't happen, failed 490. And so now I'm leaving it alone. I don't know why it didn't go up. I really thought it would. And oil fell sharply, as we talked about before. Oh, see, this is a good obvious long. Brent 80 obviously is going to be support. You're going to get at least a bounce. Where did you fall from? You fell from 82 today. You fell from 83 overall. So 83 to 80 is 3, and so your bounces will be 60. So it's 860 and 81. I'm sorry, 80, 60, and 81.20. Falling from 82 to 80 gives you 40-cent bounces, so you're going to be at 840 and 880. So basically, what you'd be looking for is that matching range where you have what do we say? It's 80, 60 on the bigger bounce, and 80 on 80 would be the strong bounce of the shorter amount, and 80-60 would be the strong bounce, would be the weak bounce of the bigger bounce. So I'd say at least 80-60, and you want to watch that 80-60, 80-80 range. But this is where you should get up to. We already did, though. We tested, oh no, that's only 80-40. So I would expect to get a bounce up to about 80-60 in the very least, possibly 80-80. And once you're over 80-80, then you're into the strong bounce from 83, which would bring you up to 81.20. So those are your lines on Brent. And meanwhile, then you expect WTI to follow suit more or less. Obviously, it's a slightly smaller amount, but it's going to more or less follow suit. But what's key, though, is this support is what's ruling. 80 is such a strong support line that when Brent hits it, WTI bounces. Not only that, though, but it also matched up to 77, which was a good support line for WTI as well. Gasoline's interesting because we've got Thanksgiving coming up, and they're probably going to jack it up also. But there's no, there's no definite reason to play. It's very tricky, and I don't think I'd want to take a big chance right now on these things. Natural gas, so I like it here. If we see support down here, I do like it because of this Europe thing that's going on. I think it might come back to 5. All right, but it's tricky. You don't want to lose too much money. Just going from 490 to a couple of points below it is expensive. It costs $50 a contract basically. So taking $50 loss is okay, but I'd rather not. And so maybe if it tests 480, I'd go long again and see how that line tests out. But then below that, I'm going to be then I go to 475 where you see support over here. But it's tricky because you say, how good is that support line really? Well, that's a pretty good line. See, 475 is a pretty good line. So 480, decent line. 475 is definitely a good line for the whole month. It's been a good line. Go back further. But this is where you realize where it all falls apart, because below that, you got a long gap down. So you got to just keep the tight stops, hope you don't lose too much money, and hope that it does actually come up with a bounce. And obviously 5 is not aiming too high for a bounce. But the cold weather coming in, the heating and all that stuff, it might be, if we get enough, we don't know how cold it's going to be. Though. We had very mild winters recently, thanks to global warming. So, but I think we should certainly be able to test 5 again. So, if you can get in like at 480 and you can get to 5, that's a nice little gain. So we'll see what happens. All right, so remind me in chat, we could take a look at that Activision or whatever. That's I wouldn't mind catching up on them and seeing what's going on in Western Digital. All right, thanks for coming, everybody. I appreciate it. And I don't know if we're going to do one next week, because it's like the day before the holiday and nobody's going to be here. But see how I feel. If not, have a wonderful Thanksgiving. But otherwise, I'll see you guys next week. All right, take care, everyone.